Hello friends, welcome to Premier UPSC IAS. So continuing with the economy lectures, this is the part 2 of the lecture and today we are going to cover national income. Income level is the commonly preferred tool used to determine the well-being and happiness of the nations and their citizens. This remains true today also, even if we know that income is not an exhaustive idea to know about the well-being of the society. There has been some reason for such a perception of the concept of income. Basically, when the idea of human development came into being by early 1990s, the concept of human development index ultimately was heavily dependent on the level of income of the individual in a country. Education and life expectancy can only be enhanced once the required amount of investment expenditure on them could be mobilized. Thus, somehow, income came to be established as the focal point of development or human development. As the income of a single person can be measured, it can be measured for a nation and the whole world, although the method of calculating may be a little bit complex in the latter's case. In due course of time, four ideas or ways to calculate the income of a nation developed, which are the subject matter of the national income accounting. These four ways to look upon income of an economy are the concepts of gross domestic product GDP, net domestic product NDP, gross national product GNP, and net national product NNP. All are different from one another, but they are the forms of national income. They all say a different story about the income of a nation in their own specific way. GDP, that is gross domestic product. Gross domestic product is the value of all final goods and services produced within the physical boundary of a nation during one year. For India, this calendar year is from 1st April to 31st March. Gross, which means the same thing in economics as total means in mathematics. Domestic means all economic activities done within the boundary of a nation or country and by its own capital. Product is used to define goods and services together, and final means the stage of a product after which there is no known chance of value addition in it. The numerous uses of the concept of GDP are as given below. Per annum percentage change in it is growth rate of an economy. Using the term a growing economy denotes that the economy is adding up its income, that is, in quantitative terms. It is a quantitative concept and its volume or size indicates the internal strength of the economy. But it does not say anything about the qualitative aspects of the produced goods and services by the economy. It is used by the International Monetary Fund or World Bank in the comparative analysis of its member nations. Net domestic product NDP. Net domestic product is equals to gross domestic product minus depreciation. Net domestic product NDP is the GDP calculated after adjusting the weight of the value of depreciation. Basically, it is the net form of the GDP, that is GDP minus the total value of wear and tear, that is depreciation, that happened in the assets while the goods and services were being produced. Every asset except human beings go for depreciation in the process of their uses, which means they wear and tear. The governments decide and announce the rates by which assets depreciate. The rate of depreciation is fixed by the Ministry of Commerce and Industry in India. The NDP of an economy has to be always lower than its GDP for the same year, since there is no way to cut the depreciation to zero. But mankind has achieved too much in this area through development such as ball bearing, lubricants, etc., all innovated to minimize the levels of depreciation. The different uses of the concept of NDP are as given below. For domestic use only, to understand the historical situation of the loss due to depreciation to the economy, also used to understand and analyze the sectoral situation of depreciation in industry and trade in comparative periods. to show the achievements of the economy in the area of research and development, which have tried cutting the levels of depreciation in a historical time period. However, the NDP is not used to compare the economies of the world because of the different rates of depreciation set by the different economies of the world. Depreciation in the domestic currency. The other way it is used in the external sector while the domestic currency floats freely as against the foreign currencies. If the value of the domestic currency falls following the market mechanism in comparison to a foreign currency, it is a situation of depreciation in the domestic currency, calculated in terms of loss in the value of the domestic currency. Gross National Product (GNP). Gross National Product is equal to GDP plus net income from abroad. Gross National Product (GNP) is the GDP of a country added with its net income from abroad. Here, the transboundary economic activities of an economy are also taken into account. The items which are counted in the segment income from abroad are private remittances, interest on external loans, external grants, private remittances. The net outcome of the money which inflows and outflows on account of the private transfers by the Indian nationals working outside India, but to India, and the foreign nationals working India to their home countries. Today, India is the highest recipient of private remittances in the world. Interest of external loans. The net outcome on the front of the interest payments, that is, balance of the inflow on the money lent out by the economy and the outflow on the money borrowed by the economy of the external interests. In India's case, it has always been negative as the economy has been a net borrower from the world economies. External grants. The net outcome of the external grants, that is, the balance of such grants which flowed to and from India. Today, India offers more such grants than it receives. India receives grants or loan from few countries as well as UN bodies like UNDP and offers several developmental and humanitarian grants to foreign nations. Ultimately, the balance of all the three components of the income from abroad segment may turn out to be positive or negative. It has always been negative in India's case. The heavy outflows on account of trade deficits and interest payments on foreign loans are the reasons for the negative income of Indian from abroad. Therefore, the general expression or formula for India follows such as GNP, that is gross national product, is equals to GDP minus income from abroad. This means that India's GNP is always lower than its GDP. Many users of the concept of GNP are as given below. This is the national income according to which the IMF ranks the nations of the world in terms of the volumes at the purchasing power parity. It is the more exhaustive concept of national income than the GDP as it indicates about the quantitative as well as the qualitative aspect of the economy, that is external as well as the internal strength of the economy. It enables us to learn several facts about the production behavior and pattern of an economy, such as the extent of dependency on the outside world, its dependency on the world, standard or quality of a nation's human resource in international parlance, etc. Net National Product (NNP). Net National Product is equals to GNP minus depreciation or GDP plus net income from abroad minus depreciation. Net National Product of an economy is the gross national product after deducting the loss due to depreciation. This is the purest form of the income of a nation called national income (NNP). Though the GDP, NDP, and GNP all are national income, they are not written with capitalized N and I. Per capita income (PCI). When we divide the NNP by the total population of nation, we get the per capita income (PCI) of that nation, that is, income per head per year. Here, the rates of depreciation followed by the different nations make a difference when the national income of the nations are compared by the international financial institutions like the West World Bank and the International Monetary Fund and Asian Development Bank, etc. As the economies are free to fix any rate of depreciation for the assets, higher the rates of depreciation, lower the per capita income of the nation. Cost and price of the national income. The issues related to cost and price also need to be decided while calculating the national income. Basically, there are two different sets of cost and prices, such as cost, factor cost, and market cost, price, the current price, and constant price. As an economy needs to decide or choose at which of the two costs and two prices it will calculate its national income. At present, India uses mainly factor cost and constant price. Cost. Income of an economy, that is, value of an economy's total produced goods and services, may be calculated at either the factor cost or the market cost. Factor cost. Basically, factor cost is the cost of the inputs or input cost the producer has to incur in the process of producing something, such as the cost of capital, that is, raw materials, interest on loans, labor, rent, power, etc. This is also termed as production cost or price or factory price. This can simply be termed as price of the commodity from the producer's side. Market cost. Market cost is equals to factor cost plus indirect taxes. While the market cost is derived from after adding the indirect taxes to the factor cost of the product, it means the cost at which the goods reach the market to sell them to consumers. These are paid by the producers to the government of India, such as GST. This is also known as the factor price and market price. Price. Income can be derived at two prices, current and constant. The difference in the prices at current and constant prices is only that of the impact of inflation. Inflation is considered standstill at a year of past in the case of the constant price, while in the current price, the present day inflation is added. The year of the past is known as the base year. The base year in India is 2011 and 12 since January 2015. Basically, current price is the maximum retail price which we see printed on the goods selling in the markets. Calculation of India's national income. India officially used to calculate its national income at factor cost. Since January to 2015, the CSO has switched over to calculating it at market cost, that is, market price, and its national income is calculated at constant prices. Similarly, similar is the situation among the developing economies, while the developed nations calculate it at the current prices. Though for the statistical purposes, the CSO releases the national income data at the current prices also. Why developed economies calculate their national income at current price? Unlike India, among the developed nations, inflation has been around 2% for many decades. That means it has been at lower levels and stable too. This is why the difference between the incomes at constant and current prices among them are narrow, and they calculate their national income at current prices. They get more reliable and realistic data of their income. Why is this data needed in India? Basically, inflation has been a challenging aspect of policy making in India because of its stability, how stable it has been, and the level of inflation that is range in which it dwindles. In such situations, the growth in the income levels of the population living below the poverty line level can never be measured accurately because due to the higher inflation, the section will show higher income. Hence, the government will never be able to measure the real impact of the poverty alleviation programs it runs for the population. Income of a person. Income of a person has the following three forms: nominal income, real income, and disposable income. Nominal income, the wage someone gets in hand per day or per month. Real income, this is the nominal income minus the present day rate of inflation adjusted in percentage form. And disposable income, the net part of wage one is free to use, which is derived after deducting the direct taxes and from the real or nominal income. Taxes and national income. While accounting or calculating the national income, the taxes Direct taxes and indirect taxes collected by the governments need to be considered. Direct taxes. In case of India, to the extent the direct taxes, individual income tax or corporate income tax, etc., are concerned, there is no need of adjustment whether the national income is accounted at factor cost or market cost. This is so because at both the costs, they have to be the same. Besides, these taxes are collected at the incomes of the concerned person or group. Indirect taxes, but the amount of indirect taxes (GST) needs to be taken care of if the national income is accounted at the factor cost, which is the case with India. If the national income is calculated at the factor cost, then the corpus of the total indirect taxes needs to be deducted from it. This is because they have been added twice, once in the hands of the people or group you who pay them, other in the hands of the governments. Thus, if the national income is calculated at the factor cost, the formula to calculate it will be national income at factor cost is equals to national net national product at market cost minus indirect taxes. However, if the national income is being derived at the market cost, the indirect taxes do not need to be deducted from it. In this case, the governments need not add their income accruing from indirect taxes to the national income either. It means that the confusion in the case of national income accounting or factor cost is only related to the indirect taxes. Subsidies and national income. Similar to the indirect taxes, the various subsidies which are forwarded by the governments need to be adjusted while calculating national income. In the case of India, they are added to the national income at market cost. The subsidies are added in the national income at the market cost to derive the national income at factor cost. This is because the price at which the subsidized goods and services are made available by the governments are not their real factor costs. As subsidies are forwarded on the factor costs of the goods and services, otherwise we will have a distorted value which will be less than its real value. Therefore, national income at factor cost is derived by the following formula. National income at factor cost is equals to net national product at market cost plus subsidies. If the national income is derived at the market cost and the governments forward no subsidies, there is no need for adjustments for the subsidies. Formula of national income of India. Putting indirect taxes and the subsidies both together, India's national income will be derived with the following formula. As India does it at the factor cost, national income at factor cost is equals to net national product at market cost minus indirect taxes plus subsidies. New and revised method of national income from 2015. The Central Statistics Office (NSO) in January 2015 released the new and revised data of national accounts affecting two changes. One, the base year was revised from 2004, 2005, 2011, and 12. This was done in accordance with the recommendation of National Statistics Commission, which had advised to revise the base year of all economic indices every 5 years. Two, the methodology of calculating the national accounts has also been revised in line with the requirements of the System of National Accounts (SNA) 2008, an internationally accepted standard. The major changes incorporated in this revision are as given below. The headlines: growth rate will now be measured by GDP at constant market prices. The major changes incorporated in this revision are as given below. The headline growth rate will now be measured by GDP at constant market prices, which will henceforth be referred to as GDP, as is the practice internationally. Earlier, growth was measured in terms of growth rate in GDP at factor cost and at constant prices. Sector-wise estimates of gross value added (GVA) will now be given at basic prices instead of factor cost. Gross value added (GVA) Gross value added GVA is defined as the value of output less the value of intermediate consumption. Value added represents the contribution of labor and capital to the production process. When the value of taxes on products less subsidies on products is added, the sum of the value added for all resident units gives the value of the gross domestic product GDP. Thus, the gross domestic product of any nation represents the sum total of gross value added in all the sectors of that economy during the said year after adjusting for taxes and subsidies. GVA at basic prices. The revision of national account statistics is done by the Central Statistical Organization. It was decided in January 2015 that sector-wise estimates of GVA at basic prices will include production taxes and exclude production subsidies available on the commodity. GVA measures the difference in value between the final good and cost of ingredients used in its production. It widens the scope of capturing more economic activity than the earlier factor cost approach. The basic price is the amount receivable by the producer from the purchaser for a unit of a good or service produced. It is considered as the output minus any tax payable, such as GST the buyer pays, and plus any subsidy receivable on that unit as a consequence of its production or sale. It excludes any transport charges invoiced separately by the producer. In other words, the basic price is what the seller collects for the sale as opposed to what the buyer pays. In this way, India tried to jump the stage of being a fully developed industrial economy, at least in the calculation of GDP. Relationship between GDP and GVA. GVA at factor cost by earlier GDP at factor cost is equals to GVA at basic prices minus production taxes minus production subsidies. GDP at market price is equals to GVA at basic prices plus production taxes minus product subsidies. Production subsidies and production taxes. Production subsidies or production taxes are paid or received with relation to production and are independent of the volume of actual production. Some examples of production taxes are stamps and registration fees, land revenues, and tax on the profession. Some production subsidies are subsidies to village and small industries, railways, input subsidies to farmers, administrative subsidies to corporations or cooperatives, etc. Product taxes and product subsidies. Product taxes or subsidies are paid or received on per unit of the product. Some examples of product taxes are sales tax, service tax, excise tax, and import and export duties. Product subsidies include interest subsidies given to farmers, food, petroleum, and fertilizer subsidies to households through banks, and subsidies for providing insurance to households at lower rates, etc.